Ho il piacere di chiamare sul palco Michela Aimar, un'altra di quella che c'era ai tempi di Show Me the Money, e quindi di farti raccontare perché c'era il tuo nome dentro a quel famoso opuscolo, e poi magari chiami tu anche i tuoi ospiti con cui andiamo ad aprire l'analisi, usciamo dall'Italia, andiamo a vedere i gestori internazionali che cosa stanno facendo. Vai.
Sì, avrei cominciato con questo. Sì, nel 2005 ero una analista sell-side e quindi ero dall'altra parte del gruppo in cui Gianluca partecipava, quindi ho ricevuto la richiesta di fare un report per questa pubblicazione che era giustamente Show Me the Money, linking environmental, social and governance issues to company value. E quindi sì, adesso mi ha stupito vedere lo stesso nome nell'evento di Luca, ma ovviamente non è una coincidenza, e ne parleremo.
Non è una coincidenza, infatti. Allora, chiami tu gli ospiti, facciamo una...
Magari mi sposto qua. Allora, i nostri ospiti sono Sara Fole, secondo. Sarah Lawlor, Head of EMEA Sustainability and Impact Client Solution at Goldman Sachs Asset Management. Thomas Hohne-Sparbort, Head of Sustainable Investing at Lombardo Dier Investment Managers. And Michael van der Meer, Head of Sustainability at M&G Investments.
Sono a disposizione le cuffie, se qualcuno ne vuole, ne ha bisogno, sono qua nell'angolo per la traduzione. Grazie.
Yeah, we have to switch to English. So, good afternoon, everyone, and welcome to this second part of the panel. I already told this small personal story. And I was saying that it was interesting to see that the title of this event was Show Me the Money, the same title of that publication back in 2005. And then, back then, Show Me the Money was a way of saying if sustainability really matters, then show the evidence, show the financial link. And maybe after more than 20 years, we have come full circle. After all the enthusiasm, the regulations, the labels, and the backlash, maybe we are returning to the real questions that is relevant for our industry. That is what counts, what is credible, and what delivers value. So we will have 2 rounds of questions. The first one is going to be about how the strategies have evolved. So we're going to see what has changed, what has matured, and what is still uncertain in order to deliver this value I was talking about. Now we have this broader market picture, and we're moving more talking about the internal framework to develop strategies and to analyze companies and build up the investment products. As I was saying, back then, okay, I'm talking about a long time ago, there were no data, no framework, not even a lot of help from the company we were investing, so everything has changed. Maybe we don't go back so much, but Thomas, maybe tell us how has your sustainability framework evolved over time? And what refinements have you done in the way you design strategy, especially with this passage from the ESG enthusiasm to the backlash and skepticism that we've seen?
Yeah, let me maybe start at the very end of your question there, the ESG backlash, enthusiasm before now, the skepticism that you're describing today. In many ways, we sort of see the exact opposite if we look at what's happening in the real economy. If we look at the real economy today, by all accounts, this should be the easiest and most natural time to be talking about sustainable opportunity sets. I could go today to any investor in Texas and say, listen, I have this technology here for you that costs roughly half of what the dominant technology costs today. Once you install it, you'll have it for perpetuity. by the way, this product will produce at zero marginal cost, zero marginal environmental, and zero economic cost. That sounds pretty good, doesn't it? That story I couldn't have told 5-6 years ago because it wasn't true yet. The technology, I'm talking about solar power compared to coal, wasn't all that cost competitive yet. It was getting there, but not quite there yet. What has changed in our framework? Actually, not all that much. We've always said we're approaching this as an investment conviction. We believe that what we're investing in are superior economic systems. My title here is Head of Sustainable Investing. You can also call me Head of Investing in Efficiency and Innovation. It's the same thing in so many different ways. What has changed over the last few years is that our conviction in the reality of this investment opportunity has strengthened. A few years ago, a lot of this was still maybe a bit of utopian thinking, a little bit of wishful thinking. Are we really going to electrify the economy? Gosh, these electric vehicles, are they really going to have the range? Are we going to have the lithium? Are these things going to stop blowing up? Surely not. Well, guess what? All of these things worked out just totally fine. What's clear now is that many of the things that many of us will have been saying in the room actually turned out to be true, on the upside and the downside. On the downside, climate change is real. Land degradation is real, and we're starting to see some of the impacts. But the positives are also true. Yes, some of the new sustainable solutions that we're talking about are demonstrably superior, and they are attracting capital at scale. And it is unlocking an actual weapons race. If you look at what's happening in China versus what's happening in the US, there's a real degree of competition going on now. So the opportunity set, I think, has become only more compelling today. What has changed in terms of the backlash is maybe a little bit of the language. Yes, we don't go out there and say, hey, listen, wouldn't you mind shifting all of your capital in your pension fund so that you can save the world on behalf of all of us? We're saying, hey, we actually have identified some pretty compelling opportunities that we think have better resilience, better economics, do not have some of the inherent legacy issues of the past. And by the way, your grandchildren will probably also say thank you to you, but you'll actually be doing from a very good position. That is the situation we're in now, and to be honest, I think that's a pretty strong position to be here. And the final thing I'll say, when we had peak climate enthusiasm, peak policy support, we had COP26, everyone was talking about sustainable and climate finance. That was the worst time to be in clean tech. Right now, we have a very different administration, a lot of skepticism, yet this is where we're seeing some climate strategies start to perform very well. Because what we have to remember in public markets, in equity markets, it's about mispriced opportunities. It's not about the rate of growth. It's whether the markets are correctly understanding what's happening in the real economy. And maybe we weren't doing that initially on the wrong side of the equation. I think now we're on the right side of the equation.
Yeah, very interesting and very optimistic, actually. So, to you, Michael, building on this, on the energy transition and this, let's say, the transition finance that is becoming more and more central, also thanks to regulation and investors' preferences. What do you see on this, and how do you blend products against this?
Thank you, Michela, and I agree actually a lot what Sarah was talking about, and also Thomas. I mean, certainly Sarah highlighted the way that I think in ESG investing we ended up with a lot of skewed portfolios, and portfolios that were maybe already green, and portfolios which were maybe skewed towards low carbon. And I also agree with Thomas that certainly, yes, as investors, we need to look often actually when the opportunity is there, when market expectations are the least, and I certainly agree with that. But what I reflected on when I was thinking about this panel discussion is also how we ended up where we are. And I think there's 3 reasons for that. Number one, we ended up where we are on the basis of where we started, and sustainability was initially quite a niche area, and it grew into the mainstream. Second reason where we got there was because of capacity. and third was regulation. And at M&G we felt we had to address all of these. And in terms of where we started, I think one of the issues is that as a niche area, there was this preference amongst those kind of investors to be already green, to see maybe sustainability more as a filter rather than as a journey. And when a lot of people came on that, they took these frameworks without adapting them to the wider economy. They also maybe didn't have the capacity in many cases to really take a nuanced approach and maybe took a very basic exclusionary approach. And then finally, I think regulation was also a little bit not accounting for the nuance around sustainable investing. And I think slowly, surely, I think the industry is starting to address those. And I think that's really the kind of the theme for us is around transition. So in the first area, in terms of our frameworks, we spend a lot of time thinking more about transition. So not just going for already green, but also from looking, okay, what is brown but is becoming green? And for us, again, as what Thomas mentioned, it's not just about the opportunity set from already green, which is definitely there, but it's also about the investment benefits of investing in companies that are transition ready, that maybe will benefit from future policy support and are therefore more resilient as well. On the capacity side, it's definitely something we felt we need to invest in, because when you start thinking about the wider economy, it's not so simple just to pick a bunch of solar stocks or wind stocks. You really need to look at companies individually and really go deep dive on them to understand their resilience and their readiness in terms of the transition. And then finally, regulation. I mean, I'm very pleased to see in regulation that there is developments there as well, to focus more on transition. And that's something I think will benefit a lot, where, having done the work on our own frameworks, on our own capacity and identifying these opportunities, and hopefully regulation will also soon recognize that as well. We see that with a lot of clients as well, that they want resilient portfolios that can outperform whether one thing is in vogue or the other. And I think we're, as an industry, getting increasingly positioned for that.
Oh, great. Thank you. Yeah, so since you mentioned sustainability as a journey, now we start looking ahead on how strategies are evolving and will evolve more. And of course, the important side is the client, the demand side. And Thomas, going ahead, how do you see your framework evolving, also taking into account new analytic tools and data management that you have available now?
Yeah, I have to apologize because I'm going to stay optimistic. Maybe it's not in fashion at the moment, but I'm an optimistic guy. Look, I think the most exciting thing that we see in terms of the evolution of our frameworks, but our strategies, is just recognizing how broad this opportunity set actually is. We've just been speaking a lot about climate and energy, but sustainability is so much broader than that. Let's talk about social, for instance. When we talk about social, people immediately think, oh, you're talking about human rights. It's so much broader than that. Let's talk about health systems. One of the most socially significant portions of our economy is health. I am sure Italy is no exception in Europe, that health systems are under pressure. We face problems there. Current systems are under strain. New economic systems are emerging. Instead of treating people when they're already sick in hospitals, we're seeing health systems emerge, focus on preventive care. That's something we don't talk enough about when we talk on these panels on sustainability, right? We very quickly go into emissions and climate change, and that's important, but health is also important. Let's talk about food systems. Affordability is also so key. Aside from the environmental impact of food systems, let's talk about affordability. Let's talk about nutrition. That is actually where you see also a lot of regulation and push from regulators coming. Can we deal with sort of the ingredients that are going into our food, the health impact that has? That also creates massive opportunity sets in terms of climate solutions. You also have nutrition solutions, and you've got the companies adopting that and making that part of their business. And finally, technology. Technology in the past has been treated as a completely separate theme from sustainability. We think it's completely intertwined. The first thing you do when you improve your value chain efficiencies is you digitize. The first thing you do when you improve the efficiency of health systems is you digitize. The moment we start to embrace and understand the role of technology, that opportunity set becomes very broad. So I would say the main way that we see not just our framework, but I hope the way we think about sustainability evolving is that we cast a much broader lens and look at every portion of the economy and ask ourselves, what is happening here? Environmentally, socially, digitally, and what opportunities, sustainable investment opportunities, does that unlock?
It's very complex as well, right? It becomes more and more complex if you put all this together. And yeah, talking about complexity and regulation, I'll go to Michael. The new regulation is entering. Regulation is entering a new phase with SFDR 2.0. We already talked about transition finance for high-emitting sector, you mentioned that, but there is also another bit controversial theme that is a broader definition of what sustainability can include. For example, defense is a big discussion going on about that as part of security and stability. So how do you expect these changes to shape the sustainable investing landscape? And I mean, what do you see about that?
Yeah, no, I think there's a couple of elements, as I mentioned, about the development of sustainability in general. One is reflecting more real-world contributions and going on that sustainability journey rather than being a filter. And the second part is the mainstreaming. On the real-world contributions, I mean, actually, I think we all actually understand that sometimes we actually want to increase our allocation to companies that are increasing their carbon emissions. So, for example, if we're looking at a solar panel manufacturer, you may actually see that on some of their metrics, their carbon emissions will increase because they're actually increasing the output of solar panels. So in the end, of course, that's still of a great benefit. Same with electric vehicles. In the short term, you may see companies like that actually increase their carbon emissions, but ultimately further down the line, because of the kind of products they create, they will reduce. And so it's actually going beyond, and also regulation. You saw that, I think, in some of the new drafts that have been released, where some of these principal adverse indicators, which really focus on a narrow set of indicators, can be broadened out a bit, so it's less of a reporting issue where you show increasing carbon emissions and really can take investors on the real-world journey in financing that transition. And on the mainstream part, I mean, defense is just a good example of that, where I think as a niche area, defense was often excluded by sustainable investors. But I don't think any government really ever supported that. I think defense is always understood as being critical to the sustainable development goals, for example, and being able to actually have, there can't be sustainability without security. And at M&G, actually, we've always had that approach, and within our Article 8 funds, we've always said that, okay, if, looking at defense companies and actually understanding at least that these are resilient businesses through our ESG analysis, we do think there is a place for defense there. It may be in some sustainable objective strategies, Article 9, that we may not have exposure to defense, but the reason for that is not because we have anything against defense per se, but because simply often those kind of defense companies may not align with our sustainability objectives in those cases, right? So in the case maybe we're looking for climate solutions or we're looking for social solutions, then it may just not be, it's more often than not the case that defense companies simply don't have something to contribute to that. But in a general term, I mean, you see that also now with what the EU is saying in terms of the omnibus, but also in terms of the drafts that have been released around SFDR. It's very explicit to say, look, we need to make allowances for mainstreaming sustainability that includes taking a wider view around about indicators, not just being a reporting function, also allowing sectors such as defense, maybe also allowing some high emission sectors where people can invest into a strategic transition approach. And I think in the end then, hopefully we'll get to a place where regulation is the floor, but our, especially as M&G is kind of a research-led asset manager, our analysis and our interpretation of that is the ceiling, right? And that's where our credibility comes from. And to be able to apply that. And I think it's always the case for us that we try to start with what we think is the right investment approach, right? What is actually a resilient strategy? And it's only after that then we look at, okay, then what kind of labeling do we need to apply to that? And I think where we're moving towards is smaller categories, but more precise ones. So if we, for example, developing an approach within the shipping industry, and we're looking at leasing vessels and so on, and we think simply it's a good business opportunity to invest in those vessels, those shipping vessels, which have the opportunity to transition. In that case, it's, I'm very pleased to see that there's more and more kind of regulatory accommodation for that, to say, okay, maybe this is not a already green strategy, this is maybe not just a simple strategy around considering certain ESG indicators, but this is really a transition strategy. And I think if we can actually get more and more finance to go into this area, supported again by improving our frameworks internally, but also increasing the capacity to analyze these more complex product solutions, and finding now also with regulation the way it's moving, I'm very optimistic that we can get to a good place on this.
Great, very optimistic. We touched so many things. I am not as good as Luca to summarize, but what I have is that so clients want substance, clarity, measurable outcomes, but they also want performance. So we're moving towards approaches that are more pragmatic and that are not only on paper, decarbonization or impact, but a real impact. And regulation is simplifying, but it's also supportive of this approach. Because we're, as an industry, we are more mature, I think, both sides, demand and offer. So, if you don't have any other consideration, I thank you very much. Thanks, everyone.